44% capital appreciation on my dividend stock picks. I've been sharing dividend stock picks here, my personal journey, just the stocks that I'm personally buying since early 2018. It started with Procter Gamble back then, although I've been sharing YouTube videos here about dividend investing since 2016, since September of 2016. But I went pretty heavy on the stock picks, sharing my personal trades, if you will, starting early 2018. And so I'm up on average on those stock picks 44%. And so I want to share that with you today. I want to share some data behind that. I have a lot of analysis. By the way, I just surpassed 50,000 subscribers. We surpassed 50,000 members of the YouTube community here. PPC Ian, Dividend Investing for Everyone. I am so incredibly thankful to each and every one of you for your support, for your comments, for your subscriptions. We did it. This is so awesome. And so this video is a celebration of 50,000 subscribers. I want to start in the video today with this look back, this look in the past of these stock picks that I have shared here on YouTube. Of course, I don't share any advice here. I'm just sharing my personal dividend stock journey, the stock selections as I've made them over time. And I want to look at the data because 44% capital appreciation, not even including reinvested dividends on average with these picks, that is really good, especially because we're talking about boring old dividend companies here, established companies, blue chips, if you will. Not talking about a lot of tech, not talking about a lot of small stocks, small caps, not talking about angel investing, this and that. Literally, dividend stocks average up 44%. That is pretty remarkable. And I'm excited about that because it helps validate the strategy. That being said, I am a humble person and I want to also look at this because I think it's a sign of the times. I think right now our market, it is getting pretty richly valued. There's a lot of risk in the market. I see in the community, quite frankly, a lot of newcomers, a lot of people just starting out here. And I think it's important to look back and to celebrate. I am so excited about the 50,000. I love you all. But it's also important to look forward and to always exercise humbleness and caution because there is some risk in the stock market right now. I continue to buy because I'm always buying. I invest for dividends and cash flow. I don't invest for the capital appreciation, quite frankly. That is a nice byproduct. But I think folks starting out now just need to be aware that there is downside potential. There is risk in the stock market. A lot of my gains are because of the exciting in-depth analysis that I've done, that I've shared here on YouTube along the way. But also, quite frankly, there's an element of luck and there's an element of market timing and there's an element of the fact that we're in just this incredible bull market. So I want to talk about that. That's going to be the first topic today. I want to talk about some other topics, though, to celebrate 50,000 subscribers. I've actually got 5 exciting topics today. The second one is I want to talk about the oil industry. So check this out. We just had a meetup last week. This was the first meetup ever in the Mid-Peninsula in the SF Bay Area. It was really awesome. I had 5 total attendees, including myself. We met up in Foster City, which is about halfway, I would say, between San Francisco and San Jose. Nice central meeting place for the Mid-Peninsula folks here in the Bay Area. I really had a good meeting, really exciting. And one of the questions that we talked about during the meeting was just the oil industry and cars, especially here, automobiles going electric. And what does this mean for the oil industry? And so after the meeting, my friend Peter, shout out, thank you, sent me some data that was really helpful that I want to share with all of you that just gives us insights into the oil industry and how much oil consumption, at least here in the United States, is related to automobiles, because that can give us all a sense of risk when investing in companies like BP, which I just personally bought some shares in. So that's going to be topic 2 today. Topic 3 is such an exciting one. This is something also that happened during the meetup. So you guys know I did a Wells Fargo video recently. I'll link to it in the description below. I wanted to go long on Wells Fargo, and I was kind of waiting. People were asking me, Ian, when are you going to buy it? When are you going to do it? Honestly, I was kind of waiting for a little dip. It did present a dip. During our meeting, literally, one of the attendees brought up, Ian, did you know Wells Fargo announced earnings today? And they're bad, and the stock is down. And then it was kind of like interesting. I also was just after the meeting on Twitter, and my friend Sam, shout out, sent me a tweet. He's like, Ian, I know you're looking at Wells Fargo. Just look at what happened today. Take a look at their earnings and such, and it may be of interest to you. And so anyways, I went home, I looked at the earnings, I started digesting all of the information, and I'm like, you know what? it's time to take a position. So I did initiate my position in Wells Fargo. I am now long 44 dividend stocks. So I want to talk about that today and the process behind that. I'm really excited. I want to talk again about BP as my fourth topic. And this time I want to look at the PE ratio, because a lot of folks get thrown off when they look at Yahoo Finance. They look at the payout ratio. Why is it paying out more than it's earning? It's not. There was some weirdness that happened with their Q3 earnings. And so I want to share how to look at this stuff, quite frankly, because I know a lot of people in the community get thrown off by PE ratios, payout ratios. They think the company doesn't have enough to pay out the dividend, but in fact, the company does. It comes down to GAAP accounting. And I've talked about this before, but I want to talk about it again. And then I want to close out today and just do a little recap on the meetup. So action-packed video, a lot of ground to cover, celebrating 50,000 Dividend subscribers, Dividend investors strong. Love you all. Let's get started with today's video. All right, so since early 2018, I've basically shared plus or minus 11 stock picks. Look, I didn't include all of them in here, but being that this exciting milestone was reached, I just want to look retrospectively at some of the picks for myself that I've shared here on YouTube. These are just picks that I've chosen for my personal dividend stock portfolio. Again, I do not make recommendations or advice. I'm just sharing my personal journey here. But I want to share one of the reasons that I put this stuff public is I want to hold myself accountable. I want to do my best possible analysis. I want to just share the journey of what's going on. And so I have 11 stocks over the years that I literally shared, and I said, hey, I think it's a good time to enter now, and so I'm going to go ahead and go for it. I'm going to do that. And so I want to put in front of you on the screen right now those 11 stocks. These are the 11 over the last 2 years or so, and I'm going to start with Procter & Gamble. Procter & Gamble was an interesting one. This was part of my strategy, actually, for I believe the year of 2018. I went really heavy on Procter & Gamble, and I thought it was a great value at this time. And so you'll see I did a video for Procter & Gamble on January 17th of 2018. And then I marked my trade date as well. Now, I was averaging into Procter & Gamble throughout the year in 2018, but I look back at my data. The biggest tranche that I bought was in May. It was in May 15th. And this was a very large tranche for me, much larger of a trade than I usually make. And so my trade price was $73.29. The current price is $126.41. And so you see right there on Procter & Gamble, just over these last 2 years or so, the capital appreciation is 72%. And so this is important to share. I want to share this, quite frankly, because I want to show that even with an established, boring, old school, dividend paying, blue chip company, it is possible to see capital appreciation. Now, I don't even invest for capital appreciation. When I invest in stocks, I assume that the money is gone. Theoretically, at least, I look at it as a sunk cost. I'm only buying cash flow. I invest in Procter & Gamble literally for the cash flow that the dividend provides. That being said, the world looks at capital appreciation, and so I just want to share this because sometimes folks think that it's impossible to keep up with the market or outperform the market with dividend growth stocks. It's impossible to have a successful strategy with these established companies. One must have to go with technology, or one must have to go with something else, with the index, etc. And so I want this to be living proof that you see, I posted the video, I did the trade, and lo and behold, I am up 72% on Procter & Gamble. But it gets better. I'm going to share some more stats on the screen as well. The dividend that Procter & Gamble is paying right now is $2.98. And so my yield on cost, the yield on cost for Procter & Gamble for that tranche that I bought, not even including reinvested dividends, I take the dividend, I divide by my purchase price, it's a 4.1%. So just within 2 years' time, I'm yielding over 4% on that tranche of Procter & Gamble. That's a pretty good dividend yield on cost for something like Procter & Gamble, which is a world-class name. Now, the analysts expect them to earn, in the current year, $4.94. And so I want to share a new metric with you here. This is a metric I've not shared before on YouTube. And so I think this is really interesting because oftentimes in the moment, price earnings ratios, they look a little high. And it's tough sometimes to invest when you see those higher PEs. And what some people do is they look at forward PE. I do that a bit. I look at forward PEs. I at least look for the current year. I don't look like, sometimes I share future years here on my channel, but mostly I look at the current year. Anyways, one thing that I think is exciting though as well, to give flavor of value and to give flavor of where companies are going, is not only forward PE, but kind of looking at what I call like the purchase price PE. And so what I do is I take my purchase price on Procter Gamble, I divide what they're going to earn in the current year, the 494. I get a purchase price PE of 14.84. And so the price earnings ratio on that tranche I bought, looking at present day earnings, is a 14.84. Now, because of the capital appreciation and because the stock is now up at 126, the current PE, if I take 126 and I divide by the 4.94, I get a current PE of 25. And so this gives a flavor of what's possible when time passes, when earnings for a stock grow. It gives a flavor of what's possible when you don't necessarily buy at fair value, but you try to kind of pick around and find the stocks that are on sale. Each year I have a strategic theme. Each year, typically the theme will involve some kind of combination of asset allocation, but also searching for value. I'm a dividend growth investor, long-term investor. This year, for example, 2020, I'm buying the high yielding stocks, but I'm not just buying any high yielding stock. I'm buying stocks like BP that I personally believe are on sale right now. So typically I try to go for some kind of strategic theme around asset allocation, around life circumstances. I want high yield now because I'm using it to pay bills, or I already am, but I will increasingly use more of it to pay bills. But I'm also still looking for that value. And so this gives a flavor that cherry picking those stocks that are on sale, not just buying the entire index, for example, it's worked for me. I've been able to cherry pick over the years, over the months, which stocks are on sale. And it gives a flavor. Procter & Gamble, it's gone up a lot now. I'm reinvesting dividends, but I'm not buying any more tranches of net new capital because the PE right now is at 25. But looking back in time, I was able to buy it at a PE of 14. Now, was that PE of 14 when I bought it? No, the earnings have progressed since early 2018. And so that's why I like looking at this kind of retrospective, this backward looking PE, this PE on cost. It's just an interesting metric that gives me comfort of where I've come from, what I've accomplished, and what can be accomplished looking forward, because I know if I buy wisely, Wells Fargo is a good example. PE kind of in that 11s and 12s range right now. If I buy wisely and if I am right that Wells Fargo is going to overcome the challenges that they are facing with their business, that PE on cost, on my actual purchase price, when I look back at it a few years from now, I wouldn't be surprised if it's maybe a 9 or a 10. And so that's what's so exciting about long-term investing. And so payout ratio on Procter & Gamble, by the way, is a 60%. That's just taking the dividends and dividing by the current earnings per share, the earnings per share forecasted for the current year. That gives a sense of financial stability, how much of earnings they're paying out. And so, by the way, shout out Brandon Beavis Investing. This is another YouTuber. He was actually just wearing my merch in his recent video. So I just want to say thank you, brother. I appreciate it. Thank you for that support. And he was talking a lot about payout ratio in one of his recent videos. So check out Brandon Beavis as well. Old school YouTuber like myself, been around for a while now, and someone who's one of my friends. And thank you for repping the merch. By the way, I'll have a link below, but I do have new merch, as you can see, like I'm wearing now. If you want to support the community, support the channel, buying my merch is one great way to do that. And I now offer merch like this that is just a little more subtle by popular demand. And these hoodies are super comfortable and awesome for the cold winter months. I love wearing this hoodie. All right, and so I want to move on now to the next one. The next one is Southern Company. I was just tweeting about this the other day. I'll share a link in the description below. Check me out on Twitter. I share most, if not all, of my stock trades these days on Twitter, most of them. And Southern is another one. I bought Southern, or I did a video back in February of 2018, February 2nd, and then my trade date was February 8th. So I bought it just slightly after. And the thing about Southern, and by the way, this isn't my only trade date. As you guys know, I'm always averaging into stocks. I tried to pick the trade date that was as close as possible to the video. I'm trying to give a sense here of literally when I'm putting my work live on the internet, I'm providing my analysis on YouTube. I'm just trying to track, like, how have I done? How have I done on some of these picks for my personal portfolio, my personal journey? And so I've had other tranches of Southern before the video. I've had other tranches subsequent. I've been investing for over 20 years in dividend stocks, but I try to pick the most relevant tranche to when I actually posted my video. And Southern Company, I bought it at $43 and change. It's currently at 67. I remember when I posted this video, I got a lot of comments. There was some challenges with one of the power plants that they were building. There was this project that was going over budget. Ian, what do you think? Is the world going to end? Personally, I like to buy dividend stocks when there's just a little bit of risk, when there's just enough risk in the market that I can kind of get a value, but I know they're going to overcome it. I always buy world-class companies when there's just something going wrong, kind of like with Wells Fargo right now. And so I don't always do that. Sometimes I just average in to build a world-class position to size, as long as it's a reasonable value. But anyways, with Southern, my capital appreciation just after these slightly less than 2 years is 54%. This is on a publicly traded regulated electric utility, a boring old utility company. Oh my goodness. And people say you can't have capital appreciation with dividend investing. This is living proof right here. And so the dividend, $2.48. My yield on cost is 5.7%. That is a thug life, amazing dividend yield on cost after just less than 2 years on a boring old stable regulated electric utility. And so the PE ratio on my purchase price is a 14. Current PE is a 21. I certainly am reinvesting here, but I don't feel comfortable buying a Southern company or any kind of company like it at a PE of 21. Payout ratio is pretty high at 80%, but that's to be expected. It's a utility. There's not a lot of earnings that need to be retained. I want to pause here and take a moment, because the point of all of this is not only to pat myself on the back a little bit, not only to, I'm trying to quite frankly explain why I think the community has grown here so much. I think it's grown because I try to provide my best quality content here on YouTube. I think it's an interesting journey that I think people enjoy following. But also I've shared these stocks that I've been buying over the years, and like Procter Gamble, like Southern, they've done well. And I think the community has taken notice of that. And I'm proud of that. And I'm proud of that because I've been doing that for over 20 years in my personal portfolio. But I want to put a huge word of caution to the community right now. What I share on YouTube is just my personal journey. It's not investment advice, not a licensed investment advisor. There is immense risk in the stock market. The stock market could crash at any time. I've shared this in some videos over the years, and especially as we've gotten higher up here, we're hitting new records for the indices. Stock market is really richly valued. And so the word of caution is kind of twofold. One, be careful when you look at my past results, your past results, anyone's past results, because there's an element of luck. With anything in life, you can do your best. You can do your best analysis. I've done my best analysis. I put my best analysis on YouTube. And like I said, with these 11 stocks I'm sharing right now, I've shared my journey and it's paid off. But quite frankly, I could look at, I'll get to that in a minute. It's not necessarily paid off because capital appreciation doesn't matter that much for me. I never plan to sell. I look at it as a sunk cost. I buy for cash flow. So for me, it probably would have been better if these stocks went nowhere. But for most of the world, this is the strategy paying off because most people do look at capital appreciation. That's why I'm looking at it this way in the video today, because I know it matters to most people out there who are investors. But let me tell you, there's an element of luck here. And there's an old saying that anyone can look like a genius in a bull market, in an upward market. But in a down market, a bear market, it's a lot more difficult. And so I just want to say there is an element of me getting lucky here. Yeah, I've bought the best possible value at the best possible time. I believe I have a really strong portfolio. I'm proud of my portfolio. I'm good at the analysis. I'm one of the better fundamental analysts out there, in my opinion, when it comes to dividend stocks. And I have a unique strategy. I feel that I'm good at what I do. That being said, there's a huge element of luck here. And so be careful when you watch my videos, when you do your own analysis, when you watch other people's videos, when you read articles in publications, Wall Street Journal or whatnot. be careful because the market has gone up a lot. And please keep in mind that it's very possible for these numbers to go in the other direction. I could just as easily, I'm up 54% on Southern. I could just as easily be down 54%. And quite frankly, if I were, I'd be buying more. I'd be getting an even better starting yield. I'd be a better situation because I buy cash flow. I'm not buying for total returns or capital appreciation. I'm buying for cash flow to pay bills. Quite frankly, that would be better. But what I'm saying is, if you're an investor, I get this a lot on my Facebook group. I'll link to it in the description below. A lot of pending invites, by the way. I will get through them. I apologize for the waiting time on those pending invites. But a lot of people on there, I even commented on this on a recent video. They're like, hey, I lost $50 or $100. Should I sell? Be careful. If that's your mentality, there may be a better type of investing for you. It may be better to focus on saving money in a high yield savings account. In fact, at our recent meetup, one of the subscribers mentioned, community members mentioned, that the Goldman Sachs Marcus account has been a really good high yielding savings account for that person, for that investor. And so just pointing stuff like that out, because this is not for everyone. Just as my stocks have gone up and I am celebrating now, I'm patting myself on the back, they just as easily could have gone down this much. And there's a huge element of luck. So buyer beware. It is more important than ever in markets like this to remind ourselves that it is very possible to lose money in an instant. Lose money on paper, at least, capital appreciation. That being said, knowing that something like that may be coming, that's why I invest for dividends, because regardless of whether the stocks go up, they go down, I'm buying cash flow. And so I tend to do well in any market as long as the companies can perform and continue to pay, if not increase the dividends over time. But I had to share that today because I think it's really, really important. Super important. And I want to move on. So pick number 3 was General Mills. You guys might remember this. Boy, I did this kind of during the time of that Blue Buffalo acquisition, the pet food acquisition. And anyways, I announced, I'm initiating a new position in General Mills in late March of 2018, early April of the same year. I bought some shares. Basically, I'm up 20% on that one. And so I've built my full-size position in General Mills. I'm happy with my stake in General Mills. This is not a strategic stock. I'm not adding a lot more to it, but I sure am happy to take that 4.4% yield on cost. Dividend's not actively growing right now at General Mills, but I think they will resume dividend growth in some of the future years. And so I'm excited about that one. Nice supporting position. Now, I also want to look at this purchase price PE. Purchase price PE is a 13. That is really cool. I'm really excited about that. That's one of the lower purchase price PEs on this entire list. And so I want to talk about that again. I have not looked at this metric a lot recently, quite frankly, on my own time or on this channel, but there is this element of safety that comes over time, especially if you're like me. You bought in days where stock prices were cheaper, stocks have gone up. Not only that, the economy has changed, the earnings have changed. I have some kind of built-in safety with General Mills now because I'm in it at a 13 PE on current earnings, whereas it's selling now at almost a 16 PE on the current purchase price. And so just worth mentioning there, that one element of dividend investing, long-term investing that I like so much is once you've been in it long enough, and if you buy at the right time, like I've been lucky enough to do, again, I want to stress this luck, after some years, there's this built-in safety because you're kind of in it at such a low purchase price PE, your earnings on your purchase price, your yield on your purchase price, they get kind of pretty comfortable because you got in at the right time, right place. And so I want to be humble here as well. I want to share something. I did a recent video and I shared how I spent $400 at Starbucks in December. And a lot of people, they were kind of saying, Ian, I'm not going to listen to you because if you can't even control that, I can't take you seriously. That's cool. Hey, to each their own. But I'll tell you, the reason I am honest with stuff like that here on YouTube is I want to share it all. I want to share the good, the bad, the areas for improvement, because I want to show everyone and myself that I'm real. And quite frankly, I want to hold myself accountable by sharing that kind of defeat, if you will, that I faced at Starbucks in December. I'm actually tallying up now I'm not going to Starbucks as much. In the last 3 days, I've had coffee at home, and I'm trying to see how long I can continue this streak. And in the month of February, when I do Frugal February, I'm going to try to really minimize when I go to Starbucks. And so by publicly sharing some of my mistakes or my challenges, it helps me. It helps hold myself accountable, because I don't want, now I'm accountable to everyone. I'm accountable to all of you because I shared that. And so, hey, if it loses credibility with a few people, it's worth it to me, because I'm doing it to better myself and to improve myself. And quite frankly, if there's someone out there that you see and they're never sharing any mistakes, it doesn't mean they didn't make the mistakes. It just means they didn't feel comfortable sharing them. And so we're all human. We're all prone to making mistakes. I just tend to share mine. And to that point, like I said, there's this element of luck. I'm patting myself on the back and sharing some of my successes here, but quite frankly, it could have just as easily gone the other way. So I got to remain real humble, and we all do. The moment we lose that humbleness in the stock market, man, that's when things start going bad. And so always just be careful. Be careful out there in the market. And so I want to move on. I want to share another one, and this is going kind of slow, so I got to be careful. There's a lot of ground to cover in today's video, so maybe I won't hit all of these, but I'll share 3M next. This is a special one because 3M was a strategic stock for me in 2019, and a lot of you remember, hey, Ian, you got some good deals on 3M. Like, for example, my lowest purchase price was down at 151. That was in 2019. But you may not remember in 2018, shout out to the Thug Life investors who have been following me since my backyard days when I was doing the videos outside in the backyard. You may remember I did a video about 3M, and I did it on May of 2018 in the springtime. And the next day I bought it at $196. Well, we know the current price is $181 now. And so I'm down 8% on 3M on my first tranche purchase there. I started buying a little bit too high. Quite frankly, I've had some tranches higher than that, even higher than that. And so I'm down even more on those. But the point I want to make here, and why I'm sharing this, is one, not all of my initial purchases picks are perfectly timed. But what's beautiful about 3M is I wanted to get in. I put a line in the sand, kind of like I just did with Wells Fargo. And I didn't know, maybe it'll go up, maybe they'll go down. But what I knew is I want to build a position, and I like to average in over time. At this time, I've made a ton of purchases of 3M, a ton. And I've averaged in. I've shared a lot of these on Twitter, if not most of them. And you've probably noticed by dollar cost averaging, I've lowered my average cost. If I put all my money that I ever had for 3M in at this price at $196, that wouldn't have been good. But I got in at lower prices. I got in the 150s and the 160s, for example. And by doing that, it brings my average cost of capital down. And so for me, when I build positions, I like to average over time. And one of the reasons is on some of these others, like Procter Gamble, Southern, General Mills, I nailed it. I picked the perfect purchase price. I picked it at the low. I got lucky, if you will. I got to stress that. We got to be humble. But on 3M, I didn't get lucky. I didn't get lucky on my first purchase. But what's funny is it's still okay. Quite frankly, maybe, look, let me share this. I just flipped this around. 3M, maybe I did get the luckiest. I got the luckiest because when I bought my first tranche, it just kept going down. So I got the opportunity to average down. Now I think it's bottomed and it's coming back up, and I keep averaging in. I get to average down and then back up. It allows me to build a full position at the best possible price. But with something like Procter & Gamble, it bought here and it just kept going up. I had very little time to average in. Thankfully, I'd bought a ton of Procter & Gamble in prior years, prior to even YouTubing. But like I said, I've been doing this for over 20 years. But you got to think, where did I get lucky? I'm a dividend investor. Did I really get lucky on Procter & Gamble? Hey, it makes me look good, but maybe it's not luck. I had very little time to average in. Whereas with 3M, hey, this actually made me look a little bad. I bought too high, but in reality, maybe that was the luck because I got to average all the way down and then all the way back up. And so when you go home, the take-home exercise is just to think, what is your strategy as an investor? And really, what is good? What is bad? For me as a dividend investor, a lot of the stuff I'm sharing now, maybe it's not so good. The market's gone up. The stocks have gone up. Less opportunity to buy at good prices. That said, there's always something on sale. And that's part of the video today as well. You'll see as I go through these dates, they're in chronological order. Over the last 2 years, there's always been something on sale. And The line in the sand I just put for right now in January of 2020, what's on sale? I think that Wells Fargo's on sale. Hey, is it going to be another 3M? Or is it going to be another Procter & Gamble? I don't know. I think it may be more of a 3M. I think it's going to go down more before it goes up. I think it may be a long road ahead. That's okay, because my starting position was very small, and I've got a long way to go. I'd rather buy in the 40s than the 50s, that's for sure. And so it'll be interesting, very interesting. But let's take a look at the next one, Campbell's Soup. I don't want to get into too much on this one, but I basically bought more shares of Campbell's Soup when there was a lot of drama about turnover on the management team, CEO turnover. Fast forward a few years, it's up 40% capital appreciation. Starbucks, this one was kind of special. Speaking of Starbucks, my $400 in December. Okay, I know I lost some subscribers over that, but like I said, I'm going to be honest with you all. I bought it $48 and it's at 93 now, so I'm up 94%. And this is in like a year and a half. I bought this in June of 2018. And so Starbucks had one bad quarter. I remember the stock was down like 10% in a single day, something like that. And what's funny is if you fast forward to the right side of the spreadsheet, my PE, purchase price PE on Starbucks is a 15.78. I want to share this because sometimes with growth companies like a Starbucks or an Apple, which is also on this list, investors such as myself get scared to buy. We get scared to buy. We were just talking about Visa, by the way, at our meetup. We are at the meetup in Foster City. Visa's headquarters, worldwide headquarters, to my knowledge, is in Foster City. They have a huge tower there. It's Visa land. And we were talking about Visa. We were talking about how it's expensive. And it's kind of like a Starbucks type stock, always expensive. Starbucks in the 30s now. I'm not buying, but a lot of investors, such as myself, get scared away from something like that. But the reason the PE is high is because the earnings potential, the growth is there. And if you get in Starbucks, when it corrects or it's at a good point, you fast forward a few years, you let earnings accumulate and grow. When I bought Starbucks, I don't remember what the PE was at the time, but my purchase price PE on current earnings is in the 15 range. And so it gives an example here how current PE or trailing 12 months PE on a high velocity growth stock sometimes can be a little misleading. And this is why people look at forward PEs. But why I like this even better than a forward PE is this is money in the bank. This is on my purchase price. And so it's just interesting. It's a case study to remind myself that sometimes it's okay to buy growth stocks even at a higher PE because they're growing so quickly. Now, would I buy Starbucks at a 30 PE? Not for me, not in my current position, but would I buy it at maybe a 22 to 25 range? Yeah, I'd consider it, quite frankly, and we'll see at the end of Frugal February when I save all this money by foregoing Starbucks. And I'm kind of starting Frugal February now in January because I got to gear up for something. I'm not just going to flip the switch. I'm gearing up. And so I'm just seeing even right now, how long can I go? How long can I go? I've already gone 3 days in a row with the coffee at home. And so we'll see. But wow, that all rhymed. Anyways, we'll see, but love you, Starbucks. And so Apple is another one. I got lucky here, but I bought in, here's what I did. I did the video in January of 19. I bought in late December, so I bought a few days prior to the video. I bought in 12/26/18. Basically, I'm up 111% on this in just over a year. Apple is an interesting stock. I saw the value at the time. Quite frankly, I still see the value. The yield on cost is minuscule. It's only 2%. Am I going to pay any bills with Apple? No, I need this thing to grow the dividend. But so here, my only success, I'd say, is the capital appreciation, which in reality, I'm patting myself on the back, but it doesn't mean much to me. I wish it went nowhere. I would have been able to buy more cheap. I'm not buying Apple here other than reinvesting the dividends. But let me tell you something. My purchase price PE on Apple now is an 11.5. Wow. That is, there's one even lower, or two even lower, but that's one of the lowest on the list. But check this out. The current PE, it's only a 24. And so the payout ratio is real low too. It's got room to increase the dividend. But what I'm trying to share here on Apple, this is a classical other example of something like a Starbucks. This is why people pay higher PEs for growth companies. Now, would I ever pay a PE of, say, 40 or 50 No. Would I even pay a PE of 30? Probably not. For me, Apple maybe in the low 20s or something like that. It's at a 24 PE now. I still think it's not a bad value as far as tech stocks go, quite frankly. I'm not going to buy Apple to 24, but if it got down to lower 20s, maybe I'd pick up a few more shares. I'd like to have more tech in my portfolio. I love Apple because it's one of the rare tech stocks that pays a dividend. But I think this is an interesting story. And again, it shows, just like Starbucks, what a dividend growth stock can do, because my PE on my purchase price, it's at an 11.5. So I love you, Apple. Let me keep going because we got a lot of ground to cover. All right, Leggett and Platt. I like this one. This is a funny little small cap company, or smaller as far as dividends go. I believe it's a dividend aristocrat. So they've raised the dividend for over 25 consecutive years. And I love these guys. Anyways, midway through 2019. See, here's the thing. I'm sharing this because it shows at any point in time, any pocket in time, market over this whole time, it's gone up. But there's always somewhere in my portfolio where I can cherry pick value. And this is what I did. May of 2019, just over half a year ago, the value was in Leggett Platt. They make bed springs, believe it or not, and among other things, but I'm up 35%. Yield on cost is 4.2, and the purchase price PE is a 14. Current PE 20. I'm not buying any more Leggett Platt, obviously, at these levels. I wouldn't want to pay 20 for a company it's not a high growth company, if you will. It's a steady Eddie industrial company. But I like it because it's a smaller cap. It brings small cap diversification to my portfolio, and it brings industrial exposure to my portfolio, which I don't have a lot of. And so that's one of the things I really like about Leggett and Platt. Anyways, moving on. Before I do that, though, on this concept of cherry picking, this is why I'm not an index investor. Now, index funds may be really right for a lot of investors, because I get a lot of people on Facebook, for example, who are mentioning they get concerned when they lose money, capital appreciation on paper, and that's okay. Index investing, there's more diversification. And so typically, I would say it's a less risky strategy than what I do picking individual stocks. I can stomach loss on paper. I'm up here a lot, and I'm talking about that because it's fun. It's a fun topic, and it sheds a lot of insights for this 50,000 video. But quite frankly, there's a lot of risk that comes with this, as I've mentioned. And so for people who like taking on risk, the value of this strategy is I can cherry pick. At any given time, there's going to be I own 44 stocks. There's going to be a handful in the portfolio that are on sale that are a good value. I cherry pick them. I buy the value at that time. By contrast, index fund investors, they take on less risk, less worry, maybe sleep better at night. For me, I sleep real well at night with this, but most people I'm talking on average, maybe they'd sleep better at night if they were not picking individual stocks, they were picking index funds. But the downside of an index fund is when you deploy money in the index fund, you're buying the index. You're not cherry picking the specific stocks in the index that are on sale. And so it's harder to be a value investor. And with an index strategy, I guess the best way to be a value investor is just to buy the index when you believe the entire index, the market, is on sale. But it's different than someone like me who can buy every single month and can always find the particular stocks that are on sale at any given time. That's why I actually do individual stocks, and I love them so much. In addition to the fact that I like control, I like to focus on high yield, and I don't want to pay a middleman. But to each their own, and there's certainly benefits that come with taking a index strategy, especially for investors who may not want to spend as much time. They may want to take on less risk. Anyways, I don't want to go through all these. It's just we got a lot of ground to cover. But Altria, early 2019, I bought at 44. I'm up 14%. Some of you out there bought cheaper than me. You bought in the 39s. And so that was really special. A lot of you share your trades in the community here on Twitter or on Facebook. Thank you for doing that. We are all one dividend investing community, 50,000 of us strong. And so it's awesome when not only myself, but everyone in the community chips in and shares some of the lessons and things that are going on in their lives and that they've learned. And so anyways, Altria, yield on cost, 7.5%. By the way, Altria is my kind of my baby, because this is a stock that I bought way back during the financial crisis, and I'm yielding over 20% on cost on my first tranche. But this is a newer tranche because I'm just sharing last few years. When I've shared these videos on YouTube, about what I'm doing at any given time. And in early 2019, I was buying some Altria. And so PE there on the purchase price is a 10, current PE a 12. Quite frankly, I may buy some more in 2020. It's still one of those value stocks, if you will. That said, I have a lot of exposure to sin stocks, so I don't want to go too heavy. AbbVie, I've got a place in my heart for these guys. And so this is in 2019. This is not a long time ago at all. Oh, that's interesting. So in this spreadsheet, I flip-flopped Leggett Platt and Altria. I guess it's out of chronological order there. Worth noting. I'm going to leave it that way when I post this on the screen and I edit my video because that's how I narrated it. Anyways, worth mentioning. So I kind of went backwards in time with Altria. Well, let's go forward in time again with AbbVie. June of 2019, I started going heavy in AbbVie, and it was on sale. $69 is where I started buying. I've bought lower. I bought AbbVie as low as $64.99. But it's now at 88. I still actually think it's a reasonable value. I'll be buying more in 2020. And purchase price PE is a 7. Oh my goodness. Current PE, a 9, a 9.85. Payout ratio still low. Yield on cost, 6.8%. Current dividend yield is still strong on this one. So the thing I want to say about AbbVie, I got to share a quick insight. A lot of people are worried about Humira going off patent protection in the United States. My understanding is the approval of Skyrizi is the next Humira. Some of the members of the community have shared with me who are very familiar with Humira. One of them is on Humira, using Humira, and was sharing these drugs only have so much useful lifespan. After a certain point, the patient needs to be moved to a new drug anyways. And the medical doctors, they're very familiar with AbbVie, with Humira. It's likely that a lot of these medical doctors will switch over some of these patients to Skyrizi anyway. And so, yeah, Humira is going off patent protection, but it's kind of at a point too where enough patients may be moving over to other things that are produced by AbbVie that it kind of works out. And so that's just some knowledge I learned from the community that I value. I haven't validated that knowledge, but I'm taking the word for it from various folks in the community. And so that's just one of the things I want to point out as well as part of this celebration, that I appreciate everyone's insights, because we have experts here in the community, 50,000 strong, probably from any industry across the world and from certainly all the countries around the world as well. I love you all. And so I continue to buy AbbVie. By the way, we'll talk more about this later in my discussion of BP, but I want to share with you, a lot of people look at AbbVie. Why is the PE ratio look wacky when you look at trailing 12 months on Yahoo Finance? Well, it's a gap accounting thing. When Skyrizi was approved by the FDA, there was something called contingent consideration that was paid to the company that AbbVie acquired Skyrizi from. In contingent consideration, I did a whole video on this previously. Just go to YouTube, search for PPC Ian, type in the ticker ABBV. You'll find it. I talk about this in the video. It's a one-time thing, and it's a good thing. It's because the FDA approved the drug, and the drug got approved, and so AbbVie owed the contingent consideration to the company that they were buying it for. And there's some other details behind it. I don't remember whether it was a cash or non-cash charge or whatnot. There was some stuff happening, but what I'm trying to say is go back to my video. I have all the knowledge there. I can't remember it at this point, but that's why the PE is funky. And so sometimes on Yahoo Finance, you see a weird PE payout ratio as well, and it looks like the company can't cover the dividend. Oftentimes, that's not necessarily the case. There's more digging that you need to do, and you need to look behind it. Why is the payout ratio that way? And with AbbVie, at least, it's a good thing. It's because Skyrizi got approved, and then they had to pay out the contingent consideration. Okay, so last one, PPL. This one was late 2019. At the end of August in 2019, I bought some PPL, already up 23% capital appreciation. Is that a good thing or a bad thing? Honestly, this of the bunch is a bad thing, because I started not that big in PPL and I've been averaging up. I just bought some recently. And so look, maybe if it were more like a 3M, that would have been better. Buy down than buy up. But with PPL, it's been skyrocketing and I've had to average up to build my full position. I still feel okay buying at these prices. But this is what's funny, is what's really good and great for some investors. It may not be for dividend investors. And so this may look like a huge win for a total returns investor, but for a long-term dividend investor, not necessarily. That being said, am I happy with the capital appreciation? Yeah, it feeds the ego. It feels good. It validates, if anything, my research, that the market believes what I believed at the time, and that I did my research, I picked it, and in general now the market kind of agrees. Yeah, Ian, you're buying it at a fair, if not undervalued price. And so it feels good to know that, hey, I'm at least headed in the right direction with my analysis. Okay, so that's segment 1. I hope you all enjoyed that. I know there's a lot behind that, but I wanted to do that retrospective because by doing that, it shares a lot of nuggets of wisdom that just pop out of an analysis like that I want to share with the community. So I want to move on now to topic number 2 of this celebration video. This is my recent buy in BP. And so the reason I want to share this, actually, I'm going to pop the numbers on the screen. You can see where I bought some BP recently. I already did a whole video on this, so I don't want to go through all the numbers. But the reason that I'm doing this is basically we were talking about BP at the meetup. And one of the things, I get this in the comments all the time, Ian, why are you investing in the oil industry? Because it's going away. I knew in my heart that the oil industry is not going away. The reason that I thought it was not going away is because oil is used for so many things. And so anyways, we talked about this at the meetup, and I just said, boy, I wish there was some data out there that showed how oil was consumed in the United States or worldwide. And lo and behold, Peter, thank you for sharing this with me. He sent it to me. There's something called the EIA, the U.S. Energy Information Administration. Thank you, EIA. I pulled these stats on EIA. I'll link in the pinned comment below so you can go to EIA, check it out yourself. All credit goes to EIA, but what they do is they break down how petroleum and petroleum products are used in the United States. And so I start looking, transportation, 69%. That's a pretty big concentration of risk, because what a lot of the pundits out there are saying is everything's going electric. It's better for the environment. 69% is a pretty big concentration of risk. That being said, industrial, residential, commercial, electric power, there's still a lot in there. But what's interesting is this is where a lot of people stop. They get one table of information, they stop, and they're like, yeah, I don't want to take on the risk when it's 69% transportation. But the important thing is transportation is a very big category. What is included in transportation? There's commercial transportation, there's industrial trucking, there's heavy equipment and such, there's all kinds of stuff. There's aviation. We all know that worldwide global aviation is on the upswing. More people are flying. It will continue to happen. Is there going to be an electric airplane anytime soon? I don't know, but I probably am thinking no. And so I looked on the EIA website. They break down the petroleum products consumed in 2018. And I want to look at these products because there's a bunch of products, and you can see finished motor gasoline is 9.3 million barrels per day on average in 2018. And then, by the way, distillate fuel, diesel and heating oil is 4.14 million barrels per day, so on and so forth. Basically, finished motor gasoline, that's the product that I think is at most risk due to the Teslas of the world, these electric vehicles. That's only 45% of oil. And so what I'm trying to say is a lot of people out there think that these oil companies are at risk of going under because they think that all the oil that BP ever produces will be used for motor vehicles. But that is just not the case. In the country of the United States of America, in 2018, based on the government reporting, only 45% of oil was used for motor vehicles, for finished motor gasoline. And so basically 45% of BP's business is at risk, not 100%. And then you start looking, is our global population increasing? Yes. Does BP sell energy outside of the United States? Oh, yes. Is everyone in the world going to have a electric vehicle? No. Is aviation and air travel on the increase? Yes. Will more people around the world need to heat their homes and use heating oil? Yes. Will there be more infrastructure around the world? Check this out. There is a line in here. It's not a big line item, but there it is. Asphalt and road oil. 1.6% of oil is used for the very roads, the asphalt that these Tesla owners drive on. So you got your Tesla, you want to enjoy your electric vehicle, you are still consuming oil because you need oil for the asphalt. And so what I am saying is petroleum is used in so many things. It's used in all kinds of stuff. Residential fuel oil, lubricants, aviation, waxes, kerosene. This stuff is used everywhere. And so this is why I feel comfortable buying oil stocks like BP. Certainly there's risk there because there is a 45% concentration. But I'll give you another example. I own a stock, Caterpillar. They make heavy equipment. Are businesses that use Cat equipment, is that all going to go electric? Maybe some of it, but I don't think the majority of it's going to go electric anytime soon. And so you start thinking, are they still going to need to use petroleum products? Most likely. And so there's this 45% concentration. I'm thankful for Peter providing this information. I kind of look at that, that 45%, there's a lot of electric happening there, but there's also a lot of worldwide growth, just population and infrastructure. The other thing I wanted to say, quite frankly, is the supply of oil in the ground. There's been new innovations like fracking, and it's helped extract more oil from the ground. But at a certain point, the reserves are going to deplete. I've seen studies by some of these oil companies, quite frankly, that there's only so many reserves. And so what do you think is going to happen when the oil, maybe there is fewer consumption of finished motor gasoline? What's going to happen, though, as the supply diminishes and the demand is probably the same as before? Maybe it's lower, maybe it's higher. I think it's going to be at least the same because the worldwide population is growing. Well, what's going to happen is the price of oil is going to go up. And so it could be like an Altria type situation where the product Altria sells has been selling fewer and fewer of their traditional products since the 70s, but the company's done well because they have pricing power. Historically, oil's been a volatile commodity. There's not been a lot of pricing power, but I imagine fast forward to 2030, 2040, 2050, when supply is dwindling, okay, hey, this electric stuff's probably good because we need other alternatives to oil because there's only so much oil. Looking decades and decades and decades into the future and the population growing. And so, hey, maybe it's all going to work out. And so I know there's a lot of naysayers that look one way and they think it's just doomsday for oil. This is why I don't think it is. But look, just my personal opinion, just sharing my personal journey. It's just another way to look at it. And so sometimes in the media, you have to be careful because certain types of people who have certain beliefs are very vocal. But sometimes there's another belief that maybe doesn't get a lot of press. It's hidden on the EIA website somewhere, but it's out there. It's out there for you to find it. And sometimes I didn't even find this myself. It came from a community member who happened to share the website with me. And so that's the value of the community as well. And so just wanted to share that. I want to move on now real quick because we're running out of time. I don't want to keep you guys forever, but I want to make it a little longer video because it's an exciting day, exciting celebration. But I want to share my Wells Fargo. So I bought Wells Fargo. I'll tell you, I'll just share it on the screen. You guys are seeing on the screen where I bought it. I bought it at $49.81. Bought it earlier this week. It's Saturday now. By the way, I want to take this opportunity just to thank my wife. I love you. My kids, I love you. Thank you so much. It is a Saturday and my wife is doing arts and crafts with the kids now, so I have time to film this video for all of you. I'll be up late night editing it tonight. The family has been so instrumental in my ability to do this on YouTube, and so I'm blessed. I'm grateful. My wife provides so much strategic direction, help. She may even be making an appearance in an upcoming video. We'll see. So just very blessed and want to take a moment to give credit where credit is due. And so anyways, I buy Wells Fargo, and I got it at a 4.1% dividend yield. PE forward on my tranche is about a 12. Earnings aren't great. Basically, they came out with a horrible earnings report. Just honestly awful. And so it's trading not that much above book value. I didn't put book here. I probably should have. I said in one of my recent videos I wanted to buy Wells Fargo. It was going to be position 44, but I then wanted to wait a little, and I was trying to wait just to see if I could get a better price. I got lucky. This is a theme today, folks. I'm lucky. I'm lucky because I have a great wife. I'm lucky because I bought these stocks at the right times. And I think it's important for you to realize that because, yeah, I'm also good at what I do, but just be careful out there. I'm just sharing my journey. I'm not providing any kind of direction or advice or anything like that. So I've had a lot of luck. But got lucky on Wells Fargo. I waited a bit, and it was like I said, it was really funny. It was during the very meetup that someone mentioned, Ian, did you know Wells Fargo's on sale today? They're bad earnings. I'm like, what? I didn't know that. And then I get the Twitter direct message from my buddy Sam, and he's like, Ian, did you know Wells Fargo? I'm like, oh, I didn't know. And so this is also something I want to point out. I don't look at the stuff as closely as a lot of you. I don't look at the quotes every minute. Sometimes there's days that go by I don't look at the quotes at all. I don't look at it. What I'm good at is when I'm going to analyze something, I go deep into the financial information, the 10Ks, 10Qs. But on a day-to-day basis, I try to stay out of it, and I stay out of it for my sanity because I'm buying cash flow. I'm talking about capital appreciation today because that's what the world looks at, and it's good to use that as a lens to get into some of these deeper topics and to uncover layers of knowledge. But at the end of the day, capital appreciation doesn't matter for me. I don't care if it goes up or down. I'm buying cash flow. And so anyways, I don't look at it every day. I just don't. And so it's made this is why I'm a dividend investor. If I looked at it every day, it would drive me mad. And so that's kind of a nugget of info I want to share with all of you. If you're looking at it every day, is that creating peace for you, or is it creating value for you? Is it helping your financial situation or not? Whole reason I invest in dividends, quite frankly, is I want more time to do other stuff. I want passive income. I want to pursue passions in life. Dividend stocks are a passion, but I also want to go running and such. And so, anyways, keep that in mind. I thought that was a funny takeaway that I was the last to hear of Wells Fargo's bad earnings and their stock plummet. But then when I did, I took that opportunity to buy some stock. And so I just want to update you on that. I don't need to go into it a lot today. Only thing I want to say is I will be buying more. It was a small starter position, line in the sand. I hope to average down. Next day it was down more. Now it's trading slightly lower than where I bought it. I hope to buy more Wells Fargo going forward and build my whole position more or less, hopefully within the next 12 months. But I like having this because it's nice to have a banking stock, pure play, large banking stock in the portfolio. I think something else I want to say on Wells Fargo. Boy, people hate this thing. It's funny. I talk about BP. I don't get that many negative comments. Who would have thought big oil? I thought people didn't like big oil. I talk about Altria. I don't get any negative comments, really. People don't care. I talk about Wells Fargo. Oh my goodness. I get comments, Ian, they're doing this and that. It's no good. It's bad. And I love this because the sentiment about this company now, even amongst the investors, is so bad. It's emotional. A lot of investors, they're emotional about it. They have an emotional kind of stake against it. I'm just saying, this is when I like to buy. I like to buy when the numbers are, I can see the future. Look, numbers ain't good now, I'll tell you that, but I can see things improving. I can see greener roads ahead, but there's enough pessimism out there and drama to create a value opportunity. I feel that way right now with Wells Fargo, and it may be a bit more drama than some of these other stocks I shared earlier in the video today. Certainly more drama than for perhaps General Mills than when I was buying it, but I'm just saying, I like hearing that. I like hearing that stuff because it tells me that there's opportunity with the new CEO in place, with them having made some mistakes over the last decade. Let's see what they can do over the next decade. I wouldn't count Wells Fargo out just yet. Okay, I want to move on to BP. Again, pop some numbers on the screen. This is topic number 4 today. Moving through the celebration of 50,000 subscribers. The payout ratio, this is actually just BP's current share price now. Just looking at the stats as it's trading now, I think it's actually, how does that compare to where I bought it? Down. It's down a little bit from where I bought it. So good. Maybe I'll buy more. Maybe it's better for it to go down than up. It doesn't feed the ego as well, but it creates more value when I'm trying to buy cash flow. Payout ratio on Yahoo Finance right now is 174%. Why is that? Because they're looking at trailing 12 months. Because we know when we're looking for, we'll check this out. Trailing 12 months EPS is $1.40. Real low, real low. But we know when we're looking at the forward PE, the forward year, analysts are estimating it at 411. So how is it? This is why I look at EPS both backward and forward. Because if I see a forward EPS, it's really good or normal, like it is for BP, and then I look backward and it's bad, usually I know something is going on, something wacky. And so lo and behold, I'm going to pop this on the screen for you all. I pulled BP's financials and I just start looking through. I look through the 10Qs. And so 10Q, by the way, is quarterly reports. And it's on the screen for you, but here on my computer, I'm still trying to pull it up so I can look at what you're looking. There I go. So Q3, basically, I just start digging through the numbers. And by the way, I go direct to the source. I look at the company website, and what they said is a divestment-related, non-cash, non-operating after-tax charge of $2.6 billion resulted in a reported loss for the quarter of $0.7 billion. This is bullet point number 2 in the screenshot I'm sharing. Now, bullet point number 1 also shows that their earnings were bad in third quarter because of price of oil and weather as well. But the point I'm trying to make here is when you see a bad PE and you come here, look, these type of, I make mistakes and I'm humble. And like I said, I got unlucky here. But these kind of mistakes, I typically don't make these kind of mistakes. I don't buy stocks that can't afford to cover the dividend. And so you see, Ian, why are you buying BP? They can't even cover the dividend. They can cover the dividend. I don't make those kind of mistakes too often these days. And so what's happened is in Q3 of 2019, their most recent earnings, one, it was a bad quarter. It was a one-off quarter because of volatile oil prices and weather. Oil's a commodity. It's tough. Price is just set by the market. It's a tough biz to be in. But more importantly, they lost a bunch of money because of this this gap earnings type of divestment charge. And so it's kind of an accounting thing. But going forward and factoring out, quite frankly, another way to look at it, sometimes when I see this stuff and I see a one-off quarter with a weird kind of accounting thing, let's say you're not like me. You don't like looking at forward EPS. You think it's too risky. What I'll do sometimes is I'll look at backwards EPS, but I'll look at the current price versus, and I'll take out the wacky quarter and I'll substitute it with another quarter. So I'll just look. So for example, Q3 was no good. So why not just look at Q2, Q1, Q4, and then Q3 from the prior year? Look at those 4. Look at what the PE would be. That's another way I do it. That's just kind of a trick of the trade that I use sometimes that helps me with my investing. And so the key takeaway here, same with AbbVie. People have asked me, why is the PE bad? It's because of the contingent consideration. It's a one-off thing. It's an accounting thing. You gotta look further than Yahoo Finance. I love Yahoo Finance. I look at it a lot. But when the numbers look a little off, don't just take it at face value. You gotta dig into the numbers provided by the companies to truly understand where they are. All right, so that's topic 4. Topic 5, just before I close out today, I'm going to pop up my notes. I want to share some stuff really quickly from the meetup. And so I'm getting tired here, so I'm going to go kind of quick. I love you all. Thank you, first and foremost, to my friends that showed to the meetup, Michael, Soren, Peter, and Nicole. You are all awesome. My favorite part, I'm telling you, of this whole thing are these meetups, and so I'm doing a lot more this year. Next one coming up is going to be in San Francisco by popular demand. It's been a while since that. We'll do it at the Starbucks Reserve. Anyways, what did we talk about during the meetup? We talk about a lot of stuff, and quite frankly, I don't share all the stuff because some of the stuff I have to use my judgment. If it's something that's kind of more like just amongst the team, hey, get to the meetups. That's where you'll hear that stuff. But I want to surface just a few things. One, is one of the attendees was sharing how that attendee invests in rental properties, and the rental properties are doing all right. It was one example that was used was a condominium, and this was a condominium invested in before the market went down, and was or I guess around the time that the market was going down. In the first years of investing in that rental property, it wasn't quite cash flowing the way that the investor was hoping, but lo and behold, fast forward to 2020, it's cash flowing well. And so it was interesting to hear that someone that invested in a condominium, did it during turbulent times, did it for cash flow, wasn't cash flowing, lets time kind of work its way out, is now cash flowing. I don't invest in those types of real estate. I personally invest in REITs, and I invest in commercial real estate properties through my job, if you will. But it was interesting at these meetups. I often get this perspective of residential real estate, these single family homes or condominiums. And it's just nice to hear that someone in the community went for it, been in it a long time, and made it work. And so that was just a nice perspective. Something else we talked about, I already mentioned, was if you're someone out there potentially who gets scared by losing capital in the stock market, that is okay. There are other ways to invest. And one of the things that some of the folks at the meetup shared is they park cash with Marcus by Goldman Sachs. I haven't used this, so I can't confirm whether it works or not. I mean, it's good or not from my perspective, just because I've never used it. But members of the community reported they're using it, and it's a high yield savings account, and they're having a good experience with it. And so that is an option with the market at the levels they're at now, quite frankly, is to consider a high yield savings account. If dividend investing, if the idea of losing, say, 50% of your capital on paper, basically take everything I shared at the beginning of the video and reverse it, that's what could happen during a crash. I could lose all those gains and be down the same amounts that I'm up. And if I'm buying now at these high levels and then I'm down that much, that's possible. If that's something that would potentially scare you, or it's, it's not the right thing for you, that's okay. There's other ways to invest. And so I thought it was interesting to hear about that, Marcus by Goldman Sachs. And another thing, quite frankly, is it sounds like folks in the community are just smart about emergency funds and having cash and investing, because one old kind of rule of thumb of investing is only invest in the stock market what you're willing to lose. And you don't want to put it all there. You want to diversify. That's why you might want to have a high yield savings account as well, because if all the money in the market is lost, hey, you've at least got that emergency fund. And so just always worth pointing out this type of stuff, especially since the market has gone up a lot. Okay, something else, we talked about MLPs. This was a really good insight. And so master limited partnerships. I own one of them. I've talked about it on this channel. You have the kind of general partners and then limited partners. I'm a limited partner. General partner is usually the sponsor of the MLP, the person running the show. What this investor said is, as he's looked through some MLPs, some of them have had less favorable terms than others, some more favorable terms than others. I'm talking about the agreement, the operating agreement between the general partners and the limited partners, and the fees and the fee structure and the gravy that the general partners make. This was interesting because this is how I look at real estate, quite frankly, real estate deals when I analyze them. Privately held real estate, but it applies to MLPs as well. So I thought the takeaway for myself and for other investors in the community is, if you are considering investing in an MLP, keep in mind, not everyone's on equal ground. There's general partners, there's limited partners, and you might want to look at operating agreements and legal agreements to understand, what is the general partner getting that I'm not? That's basically what it comes down to. And I thought that was really wise wisdom from one of the team members. So thank you for sharing that. We talked about BP a little bit. I know we talk about BP a lot, but I thought one of the investors brought up that was that BP, out of all of the oil companies, is an interesting one because they're investing a lot in solar power. They're investing a lot in wind power, and they're actually generating power that way and selling that power out. And so I thought that was interesting. I always hear BP beyond petroleum. They're trying to find other ways to generate power, be an energy company beyond petroleum. It was interesting just to hear from the community. Ian, you ought to look into that deeper, because my research shows that that's what they're doing. So that was kind of another nugget of wisdom on BP, is that looking 30 years out or so, it may be a company less dependent on petroleum than it is now. And so that's another kind of argument against this fact that, oh, everything's going electric, they're doomed. Not necessarily, because they're in the solar power, the wind power as well. So I thought that was a unique takeaway. We talked about some favorite stocks from the team. One of them brought up was JP Morgan Chase. I know when I bought Wells, I got a lot of people stepping up saying they like JP Morgan Chase better. Hey, more power to you. I wish everyone all the best in that stock too. It seems like a good one based on my analysis. It's not the perfect pick for me, but that doesn't mean that it's not the right pick for other folks. And so we talked about Texas Instruments. This came up in the last meetup as well. Analog semiconductor company. Thought that was really interesting. And we talked about Visa. I'd always been wondering about Visa, like, doesn't everyone already have a credit card? But what was interesting is there was a statistic brought up in the meetup that there's a large percentage, still worldwide, of folks that are still using cash. Huge percentage. And so the belief was that more and more people will be going to credit cards and products that are provided by Visa. And Visa did make that big tech acquisition of the Plaid company recently for like $5 billion. I don't know too much about that, but from what I've read, it seems like a good strategic move to kind of make sure they're aligned with cryptocurrency and disruptive companies in the fintech space as well, because that Plaid, my understanding, is used as the backbone for a lot of fintech. So that was very interesting as well. Anyways, there was more discussed. We were there for, I think, around 2 hours or so. It was a really great meetup at Starbucks, of course. And I encourage you to try to make the meetup if you can do it. And I do apologize that they're only in California, just based on my ability to travel, my work schedule, etc. I got to do them here in California. But one day we will have them elsewhere throughout the country and hopefully throughout the world as well. That's an aspiration on my list, my to-do list for sure. All right, everyone. Thank you for hanging in there on this celebration video. Before I leave today, I want to do a full disclosure. The stocks mentioned today I own, and so I own these stocks. I want to go through them very quickly. I am long on Procter Gamble, ticker symbol PG, Southern Company, ticker symbol SO, General Mills, ticker symbol GIS, 3M Company, ticker symbol MMM, Campbell Soup, ticker symbol CPB, Starbucks, ticker symbol SBUX, Apple, ticker symbol AAPL, Leggett Platt, ticker symbol LEG, Altria, ticker symbol MO, AbbVie, ticker symbol ABBV, PPL Corporation, ticker symbol PPL, Caterpillar, ticker symbol CAT, BP, ticker symbol BP, and Wells Fargo, ticker symbol WFC. I am long. I own all of those stocks in my personal dividend stock portfolio. Also, as mentioned throughout the entire video today, today's video, in terms of a disclaimer, is not investment advice. I'm not a licensed investment advisor, just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here for your fun and entertainment purposes only. As always, additional disclosures in the description below. Check it out. And with the stock market trading at these highs, will these picks that I share going forward, like Wells Fargo, will they experience capital appreciation like the ones I shared earlier today? I have no idea. I do my best in the moment to assess value, and we'll see if there's a little bit of luck on my side or not. But like I said, even if the market goes down, that's probably more lucky for someone like me who just wants to accumulate cash flow. So it's so interesting how reframing stuff, just looking at it a different way, gives different perspectives. If you want to subscribe to the channel or support the channel, please subscribe, comment, like. It means the world to me. Check out the merch. I love you all. I will see you all in the next video.